So have you ever had one of those Mondays where absolutely everything goes wrong? Well, imagine that, but for the entire global financial system. On the 19th of October 1987, global financial markets didn't just wobble. They fell down the stairs, tripped over the dog, set fire to the kitchen, and phoned in sick for the rest of the week. This is the story of Black Monday and why it still matters even today for mortgages, money, and modern insurance. So, first of all, welcome back to the history of money, mortgages, and insurance. This is a series of videos where we take a look at some of the most serious financial disasters in history. We take a look at the whys and the wherefores and how they affect our financial lives today. I'm Patrick Wakeman and I'm your guide through economic chaos. So Black Monday happened on the 19th of October 1987. When stock markets across the world experienced record declines, it was an economic shock the likes of which had never been seen before. The Dow Jones fell 22.6% in one day. Still to this day, it's the largest one-day drop in history. The FTSE 100 fell by over 10%, and markets from Hong Kong to Australia and Europe to the US joined in the collective panic and self-destruction. And unlike the 2008 crash, this wasn't about dodgy mortgages or loan packaging. This was about technology, psychology, and some very 1980s financial engineering. Leading up to Black Monday, the stock markets were seriously overheated. Stocks had been rising like a badly calibrated souffle. And by mid-1987, stock market valuations were seriously stretched. But for some reason, people were still weirdly confident. And that's never a good sign in finance. And added to this came the birth of computerised trading. Wall Street had started using new computer systems, programmed for something called portfolio insurance. This was a strategy that was designed and programmed to automatically sell stocks if markets fell. It was there to protect investors. It was meant to limit losses, but instead it did the opposite. As the market started to fall, it sold. As the market started to fall more, it sold more. And as the market started to collapse, it sold everything. It was like a car stuck on cruise control that was heading towards the edge of a cliff. And that was only part of the problem. As the computers started dumping shares, human traders assumed that something catastrophic was happening, and they panicked too, which made prices fall further, triggered more computer selling, and that led to more panic from human traders. The whole thing just turned into a massive doom loop. And because capitalism comes with its own version of Snapchat, the panic quickly spread across the world. Hong Kong dropped 45% in a week. Australia and New Zealand soon joined the chaos and followed New Zealand down. And the UK market plunged, as the city tried to work out if this was the end of modern finance or just another Monday. And by the end of the week, trillions of dollars had been wiped off global markets. Now, things like mortgage rates didn't spike up immediately. This wasn't a banking crash, but it left the world in a state of serious economic uncertainty. And that led to slower lending, tighter credit, a much more cautious Bank of England, and a knock-on impact to consumer finance. Basically, the world was holding its breath. And ironically, it was traders' portfolio insurance that helped cause the crash, rather like having fire insurance that made your house more flammable. The insurance industry had to completely rethink it. Better risk modelling, more stress testing, and correlation assumptions, realising that everything can go wrong. And as Murphy's Law says, if anything can go wrong, it probably will. So the 1987 crash exposed the danger of automated trading with no oversight, and the need for circuit breakers, proper limits on how fast a market could fall. And it's those circuit breakers that were introduced after 1987 that are still used today. And they've prevented several modern meltdowns from becoming 1987 all over again. So Black Monday rewrote the financial rulebook, and its fingerprints are all over the modern economy. From those circuit breakers that can stop markets from falling and halt trades, to better regulation on derivatives, closer oversight of automated trading, improved risk controls for insurers, and more importantly for homeowners, a much more cautious approach to lending, and a vision of what sharp market shocks can do. This is why even today when we look at mortgage affordability, we stress test the loan against rates that are several percent higher than the one you've agreed. We look at it under tougher conditions than the best case scenario. Because one thing that the 1987 crash absolutely proved was that sometimes the markets can decide to run a mile in clown shoes and there's not a lot you can do about it. So that's Black Monday and the day the markets fell. So if you've enjoyed this little swan dive into financial chaos, then give me a follow. I'm Patrick Wakeman, your local East Midlands mortgage protection advisor, serving clients all over the UK. And if you want to get in touch, then my links are in the bio. Speak to you soon. Bye-bye.